one of the things that we've seen disappear from the marketplace, like just overnight, and I know it's not completely gone. It's not like the product isn't available, but just the buyer's preference to do the 203K or the home style construction loan, we just don't really see it anymore. My suspicion is we already know it's a higher interest rate typically than your standard conventional. Cost of material is through the roof, and then you're still paying a premium on the house, even though it may be cosmetically dated, front to back, need work. You need to add an addition to make it work for you. You're still paying top dollar for that home. You're not getting the discount for it.
Not unless we've had, some rare occurrences where, let's say the home was what we would call, let's say like a C5 on an appraisal scale, where it's unfinanceable. Let's say that someone, started to do a renovation, ripped the whole kitchen out.
I got you. Yep.
And now there isn't the option for regular financing, essentially. It's either a cash buyer or renovation loan. Those cases, we're still seeing renovation loans being used, right? But I think where you were going is where we used to see it a lot on grandma's house, right? Where the home was 100%.
I bought my house on a construction loan.
100%. We did a Fannie Mae HomeStyle on your house.
Yep.
But you got it at, like you said, that discounted amount.
Nobody else wanted to touch it.
I think construction is a huge part of it. I think you and I talked about this, that when I was doing, different add-a level projects prior to 2019, I was paying under $100 a square foot to do these projects. If I did the same project today,
$200.
I'm paying more like probably $170 a square foot to do that exact same thing. And that's my price. That's me having those connections, right? Like with builders and so on, versus your regular consumer who probably doesn't have that, especially that first-time buyer. It makes it harder for the deal to make sense. With FHA's 203K, we can go above the after-repaired value. So that's still going to be an option for us, but HomeStyle only allows up to that 100%. Like you had said, people have a hard time with the rates today as it is, right? Like, they're not really loving the idea of a high 6% rate or something with a 7 in the beginning. And now we throw into the mix, it being a renovation loan and the rate being higher, the fees on the deal being higher, because there's so much more incorporated.
There's cost overrun, there's displacement, because if you're behind a month or 2 months on your project, okay, great, we now own this house, we're paying a mortgage, we can't move in because it's not completed. I get the point.
My personal opinion, everybody's wrong. To me, this is the time where it should probably be utilized the most.
I agree.
Think realtors should be looking for those homes with the 30 plus days on market, looking for it where it says, cash only, or, but it's still a price that's outside of an investor's, what they're looking to pick it up for.
That's the gap I think the general public and a lot of, inexperienced real estate agents don't realize, is the investors will stay away from the MLS for the most part. They know there's open market competition. They know there's already like a retail fluff built into the price.
But they're still in there. They
kick around. I have them. I get them coming in, and I have one sitting right now, 425. All of our offers are coming in the 300 range. This is 125,000 under list. This house is worth, maybe in my opinion, $365,000. The investors are going obviously to where it makes sense for them. Doesn't make sense for the seller. Where it makes sense for them. That gap in between, a home buyer can still gain positive equity. Come in there, 350, 365, make the renovations, 30, 40,000 bucks, kitchen, bathroom, and move on. Happy. They're just absent from the marketplace. They're not slotting in. I have no idea where it stopped. I mean, I think, like you said, affordability plays a factor. Maybe inexperience.
I think that a lot of people don't also realize that there's always an exit strategy with these renovation loans, even in a healthier interest rate environment.
It's a great way to steal a large amount of equity. When everybody else is passing on it and it's not moving, you come in and you want to actually do the work, you're going to gain that amount of equity that you put back into it.
Well, that, and you're also going to be getting a house that, the design, let's just say, that you want, right? You're going to get the kitchen that your wife wants. You're going to get, the bathrooms that you want, the colors that you want, the floors that you want, everything that you want versus maybe a house that you love 50% of it, but there's a lot of things that maybe you wouldn't have done.
Need to change. Where before you move in, you need that customization. One of the other things too that, consumers and agents don't take into consideration, when you're doing one of these remodels, you bought the material. You have the contractor's contact. You've supervised and managed the job. You've been in conversations with the building or the zoning department. If problems arise, you can go back to that person after that work has been done. You buy a house from a house flipper, you close after your inspections, you start having issues with either the material or the workmanship, chances are you're not able to get back on the phone with that general contractor and say, hey, man, this middle island is wired incorrectly.
Well, that and the fact that what a lot of people don't realize is with a renovation loan, the check as draws get released to the contractor, those draws are made out to you and the contractor, which means that both signatures need to be on the back of that check for that check to be cashed. The whole way through that job, not only are you going to have a say on whether or not
second set of eyes.
You also have a HUD consultant involved in this, which is somebody that you hire, which we're going to obviously as a lender, provide you with some contacts, but they're generally either a, kind of a home inspector or a contractor essentially by trade who is now a HUD consultant, and they're telling you what's normal, what the correct price is, both high and low. Right? Because you have contractors that will come in and offer something and say that they could do it for $10,000 when, the HUD consultant and another contractor are saying $15,000. They're not going to say, hey, you got a great deal, congrats. They're going to ask them why.
They're going to say, where are you cutting corners? What is the cost of this material?
And you might look at that as being negative, like why are you trying to rain on my parade and take away this great deal I got? But the reality is it costs what it costs, and you're going to end up being left holding and coming out of pocket to finish this job.
If you pay somebody $4,000 for a new roof, you're getting a $4,000 roof.
You're
not getting a
quarter of a roof. Whatever. But they're always going to come back to you and say, hey, whatever, I ran out of money. It is what it is. It costs more. And
well, they bid down to get the job.
That's it. And they feel as though you're not going to obviously leave a quarter finished roof, so they're going to get their money one way or another. And by getting a renovation loan, you're protecting yourself from that, right? You can't be taking advantage of that. And is there a little bit of a premium on it in terms of the interest rate? There's no other way, unless you have other means for that renovation money and it not be a loan of some sort, there's nothing cheaper. If you have, if your parents can lend you money, if whatever it might be, something like that, great. That's awesome that you have that option. But for a lot of folks, they don't have that option. This is by far a greater option than taking a personal loan, getting a Home Depot credit card, which is what a lot of people,
30%. Yeah.
This is what people do though. We have people that talk to us about a rental loan. They go forward and still buy a house that needs a full renovation with a regular mortgage because it is still technically financeable. And they are back talking to us within less than 2 years because, we're knocking out $30,000 worth of credit card debt that
they put on a card.
They thought was better than taking a 7% rate probably at the time, on that rental loan. And obviously now they're wrong, but it's
cheap is expensive.
It is. And we can't say to them, oh, told you we were right. It is what it is at this point. We just have to.
He's got to go help them fix it.
That's it. That's all that can be done. So I think more and more realtors should be looking at these properties that have more days on market, that, don't have as much interest. And if it's in the area that the person likes, this is a great opportunity. You could even, which a lot of people don't know, you could finance some of your mortgage payments. So if you do need to stay in your rental for an extra 4 months and there's room in the deal, especially with an FHA 203K, because you can go above, you could finance the first 4 payments. So, you're not even doing a double payment. So like talking to us about it and finding out really what your options are is better than assuming or listening to somebody that
Googling it.
That maybe Googled, renovation loans before and some reason something, scared them away. But these are great options. FHA has a renovation loan available. VA has a renovation loan.
VA has a product,
Obviously Fannie and Freddie, which are conventional loans, those have options available. And you could do things as luxurious as an in-ground pool with some of these renovations.
That's crazy.
Loans. So it's not even a matter of just replacing the things in the house that
you could
are
upgrade
not working.
within reason.
You could upgrade. So again, it has to fit within that after repaired value. But we've seen some, again, your own house. We've seen some really amazing transformations. 20 years ago, the only option would have been cash.
To buy it and fix it yourself.
That's it, and cash. Which who
has that? Who has that laying around? For the most part,
no first-time buyers generally. That's for sure.
You're limping to the closing table with basically clearing out most of your savings at that point, and you're taking on a larger expense. Normally, you're moving from your one-bedroom apartment that costs you
And
$1,500 a month.
Yeah. And for me, the reason that I said that to me it makes the most sense right now is that every person who's buying a home right now that has bought a home, towards the tail end of 22, bought it in 23, 24, you're refinancing.
Yeah.
There's going to be an
It's gonna
opportunity to
happen.
refinance. So what's the difference if you're refinancing from 6.5% or 7%?
Yeah.
Or 7.5% down?
And
honestly, it's going to make it a larger savings, but you're still getting that house probably sooner.
And even still, even if you do not have an opportunity to refinance, say 5 or 10 years down the road, I believe that the rate will come down. If it doesn't, you're still locked in on a 30 on what could potentially be a higher rate. Who knows? Maybe 10 years from now, we're at 10%. We have no idea. However, if you're locked in now, you're locked in for a 30-year term, and maybe that renovation loan doesn't look quite as bad if we see another increase in rate.
It doesn't, because at the end of the day, the rate is honestly slightly higher, and in a lot of cases we could even get it so that you could buy it down, maybe buy a point or two and get it down to where it really would be as a regular conventional or FHA loan. And then the only difference being is whatever you're borrowing for the renovation itself. But again, in a lot of cases, you're getting that home for probably a better value even with those renovations than you would be getting a home that a flipper did for you.
The second a flipper buys it, either they're good flipper or bad flipper, doesn't matter. The second a flipper buys a home, they're going to buy it at their price. They're going to put their material, they're going to put their construction, their money into it, and then they're going to look for a return on that investment on top of that. So they're not selling it at what they put into it.
No,
they're selling it for as much as humanly possible. And the ones that are done, move-in ready, drop your bags. That's where we find the highest amount of competition.
Yep.
That's where you find the most amount of bids, because they are, not for a loss here, but they're appealing to the eye for the most part.
Yeah, and especially in a market right now where I think buyers are exhausted.
Yes.
And, the more and more that they're shopping, the more they're getting beat out on things. I think that the more that turnkey property sort of makes sense to them versus the idea of now, I just went through this grueling battle to even get an offer accepted. And now I have an even longer road ahead of me in terms of renovating. But those are the same people that I feel like are, pass up on that renovation opportunity. And 4 months later, we're still talking to them because they're still shopping, looking for that needle in a haystack, right?
Yeah. It's a great diversion, or it's a great alternative to somebody who's hopping around, carting around that FHA 3.5, which for the most part, they're boxed out. They really are. I mean, I would love to see the FHA and the VA do something to help reopen that pathway to home ownership, especially in New Jersey. We do not have an opportunity to give FHA loans out anymore. We really don't. As soon as they come in with that lower down payment, and we know that 96.5 loan to value ratio is going to become an issue because there's no historic precedent for that price. One of the famous quotes I heard from an appraiser: we don't get paid to figure out where the market's going. We can only tell you where the market's been. And that's how we set the appraisal. That burned into my head, that if you are setting the market in your neighborhood for 550, 50,000 high or more, that FHA appraiser, they're going to go back to the 500, and that's where you're capped. That is it. They're just not going to take the risk of getting a default.
And I think where that FHA buyer can be much more attractive
construction loan.
Buy a home that not everybody wants. You get borrowers that are FHA approved, and unfortunately that is their only option. It's a great option, but just obviously, like you said, not as desirable on the seller's
it's a risk. It's a risk decision. It's not anybody trying to stop a first-time home buyer or a veteran from getting what they want.
No, but it's more skin in the game. That's what obviously a seller wants to see, is more skin in the game. If you're putting 20% down and 10% into escrow,
it's less risk for them.
Obviously, that's going to be more appealing to that seller than someone who's putting 3.5% down and only $5,000 into escrow.
Correct.
Listen,
it's just
that
a reality
person is looking out for their best interest the same way that buyer, let's be honest, is looking out for theirs. But going after that property that not everybody wants is the cheat code. That's where they're going to look at it and be like, whatever, FHA 203K, this is what we have available. This is our best option right now as the seller, is to accept this type of an offer because we don't have anything else. And there's 15 other offers, unfortunately, you're not going to size up. So I think that a lot of times where we have agents that are working with these FHA buyers, they should know that us as loan officers, I'm not trying to put them into an FHA loan. We're always trying to do everything else that we can at this point to make them the most competitive buyer that we can. But in some cases, unfortunately,
affordability
that
again.
is the only, you know, and in some cases it's cheaper for the buyer, right? They don't want to stray away from FHA because the mortgage insurance might be better, you know, and the rate is much more credit forgiving on FHA than it is conventional. I just think that those are the buyers that you guys have to start hunting for days on market, not really necessarily, you know, in the right areas or areas that they can see themselves in. And I think you're going to have different luck.